So guys, I've been dividend investing now for the last 5 years and some change, which in the grand scheme of things is really not a super long period of time, but still in this relatively short amount of time, I've made a few mistakes, and I've learned a few pretty important lessons about dividend investing that I want to share with you today, starting with this one here. So just as a recap, a Dividend Aristocrat is a company that's increased its dividend every year for at least 25 years, and a Dividend King is a company that's done the same, but for 50 years. Now, don't get me wrong, there are a lot of great Dividend Aristocrats and Dividend Kings out there, and an extensive dividend growth history is definitely something that you'd want to see in an investment. You know, you want to invest in companies who've proved that they can sustain a growing dividend. Having said that, though, I think a lot of investors, especially new investors, make the mistake of thinking that Dividend Aristocrats and Dividend Kings are invincible and that they're like the best dividend stocks out there, when in reality that's not always the case. And at least for me, I had to learn this lesson the hard way by investing in 3M. This was one of the first dividend stocks I ever bought, and I remember at the time thinking, you know, this is a huge company, their products can be found in pretty much every industry, so they're very well diversified, plus they're a Dividend King with over 60 years of dividend growth, so what's not to love? That was pretty much the extent of my research, and what I didn't realize at the time was that 3M was actually a pretty stagnant business, and their revenue and profits really hadn't grown at all over the last decade, which at a certain point was going to be problematic for the dividend. And meanwhile, they were in the middle of some pretty serious litigations that ended up being a huge drag on the company. Long story short, if we take a look at the sold positions page over here on my dividend portfolio tracking spreadsheet, which you can start using for free, there is a link to download the spreadsheet in the description of the video. But looking at this, we can see that I ended up taking a pretty big loss on 3M. On a total return basis, I was down 27%. Just looking at the share price, I was down even more. I was down 33%. And I ended up selling my shares for quite a big loss. My average cost was $165. I sold around $110. And fortunately for those who decided to hang in there, the share price has since recovered a lot more, but I was down big with this one. And with this, 3M did eventually cut their dividend, which for the health of the overall business was definitely a necessary move for them, but it still goes to show that even the most royal Dividend Kings can fall on hard times. And 3M actually hasn't been the only Dividend King that we've seen cut their dividend. In the last couple of years, VF Corporation, VFC, also cut their dividend, not once, but twice, which is every dividend investor's nightmare. And another Dividend King, LEG, Leggett & Platt, cut their dividend last year to the tune of about 90%. Overall, the takeaway from this is that there is more due diligence required than just looking at a company's dividend growth history, and there's more due diligence required than just looking at the dividend stats in general. You need to look under the hood in the financials to make sure that the company's even growing and that they can afford to continue growing the dividend. Now, in the same way that you shouldn't buy a stock just because it's a Dividend Aristocrat or because it's a Dividend King, you also shouldn't buy a stock just because it has a high dividend yield. And we've probably talked about this to death here on the channel, but it's such an important concept that I think it's worth revisiting every so often, because there's something about how we're wired as human beings that makes us dividend investors gravitate toward the highest yielding investments that we can possibly find. It's just one of those things about human nature that doesn't change. We always want what we want, and we want it now. And so I think every so often we need a reminder not to chase yield. Now, don't get me wrong, there are some very solid and very dependable high yielders out there. I think I've got a couple of them at least in my portfolio, but there's also some very bad ones, and it's pretty easy to tell the good high yielders from the bad. Taking a look at an example over here on Snapstock, which you can start using right now for your own stock research and analysis. There's a link to Snapstock in the description of the video and in the pinned comment. Before our example, we'll be looking at Dynex Capital, ticker symbol DX, which someone actually just asked me about in a comment, wanting to know if this might be a good investment, so I figured it would be fitting to check it out in this video. Now, if we look at the dividend stats, I believe what drew this investor to Dynex and made them curious about it was the dividend yield, which, as we can see, is sitting at 12.4%, a very juicy dividend yield. And looking at the dividend history chart, it's pretty easy to tell that this is a high yield stock you would want to avoid at all costs every single year. This company is reducing the dividend payment per share. 10 years ago, they were paying out almost $3 per share. Fast forward to today, it's basically half that, which is the exact opposite of what you want to see. With this stock, even though it has a high yield, your cash flow return is actually going down over time. You want to invest in companies who are increasing their dividends and increasing your cash flow return over time. So moral of the story here, like I said, you only want to invest in companies who can actually increase their dividends. I don't care how high the yield is. If you see a stock like this who is doing nothing but decreasing their dividends, that is a stock you want to avoid at all costs. It is a great thing to be able to buy stocks below your cost basis, below your average cost per share, because you'll be able to buy more shares with the same amount of money, and you'll also be able to lock in a higher dividend yield, because as the share price goes down, the dividend yield goes up. Still, there's usually a reason why a stock share price goes down, and it's your job as an investor to understand why that is. Sometimes it's nothing, in which case buying the dip is a great idea, but sometimes the share price might be going down because of underlying issues within the company. Let's look at Dow Inc., ticker symbol DOW, as an example here. We can see that in the last month, it's seen a crazy drop. It's down 24%, and if we look at the performance over the last year, the stock is down about 56%, so it's just lost a ton of value. With that, though, we can see that the stock has a lot of red flags. According to SnapStock, there are 8 different red flags, and the overall Snap score, which is a gauge of quality, is very low, only at 3.4, and it is scoring very low in the growth and profitability departments. So that gives us some sort of clue. Let's scroll down and take a closer look into the numbers here. And sure enough, one of the first things we'll notice here is that earnings per share has really fallen off a cliff. Look at this, guys. It's really gone down. And the same thing is true with the free cash flow per share. It peaked in 2022, but then it steadily made its way down to the point where actually last year in 2024, the free cash flow was negative, and so far in the trailing 12 months, that trend has continued. With that, if we scroll down, the margins have declined across the board. The gross margin has consistently declined over the last 10 years, so that's not great. And we also see a huge drop off in the net profit margin and the free cash flow margins since 2021, 2022. Pretty similar trajectory as what we saw in these charts up here, actually. Scrolling down, looking at the debt situation, we can see that the net debt has considerably increased as well. So while earnings and free cash flow have gone down, they've taken on more debt, and it's gone from $12.8 billion on a net basis up to $16.5 billion. So that's a pretty big jump. Meanwhile, the interest coverage ratio has gone down. The interest coverage ratio used to be very high, 12.15, 10.4, but as of late, it's gotten real low. In 2024, it was only 2.35. That is way too low. And in the trailing 12 months, it's hardly breaking even. Now, with that, kind of like we saw with Dynex just a moment ago, Dow has become attractive to some investors because as the share price has plummeted, the dividend yield, as we can see here, has really taken off, and now it's sitting at 9.6%. However, it's not all it's cracked up to be. If we scroll down looking at the earnings payout ratio here, in 2023, they were paying out 335% of their net income in the form of dividends. In 2024, it was 176%, and in the trailing 12 months is over 500%, so they are paying out way more than they're generating. And with that said, it should be no surprise to find out that Dow just recently cut their dividend in half. They slashed that thing, as they should have. It was just not going to be sustainable at its current level. So in this instance, even though the share price got a lot cheaper, and even though the dividend yield got a lot higher, so it looks attractive on the surface, under the hood, the business itself appears to be declining in a big way. So this is a dip that I personally will not be partaking in, and hopefully it makes sense why. If you're early on in your investing journey, it can sometimes feel like you're drinking from a fire hose of information. You're probably watching a lot of YouTube videos, reading a ton of articles, and just taking in everything you can, which is great. You want to be a sponge and soak it all up and learn as much as you can. But with that said, you shouldn't just listen to us talking heads here on YouTube and take everything that we say at face value. And you definitely shouldn't be doing something just because Ryne is doing it, or because Russ is doing it, or because the Dividend diplomats are doing it, or whoever wherever else. All the different people that you watch and listen to here on the internet are good places to go to get ideas, and it's definitely fun and inspiring to see other people's portfolios and see what they're doing. But you have to remember that we're not always going to get things right. You know, I love talking about the inner workings of my portfolio with you guys and sharing all of my thoughts and the things that I'm doing. But there have been, as we saw with 3M, there definitely have been times, and there will be more, where I won't get things right and I will lose money. And that is true with every other investor that you follow. And so because of that, you shouldn't do things just because someone else is doing them. You know, if you're going to buy something, you should do it because you think it's a good investment and because you understand your reasonings behind that. You can't outsource your beliefs and your convictions to someone else. That's not true just in your portfolio. That applies to every area of your life. You can't let people think for you, and I can't tell you how important it is to understand that. You'll often hear certain dividend stocks like Procter & Gamble or Pepsi or Coca-Cola being talked about as being these sleep well at night stocks, which basically means you don't really have to worry about them. You can sleep well at night holding them in your portfolio. And while that's true, that's not to say that you should just buy and completely forget about these stocks. You know, businesses, no matter what they are living, breathing entities that are constantly changing, and they're constantly fighting for survival. So you need to keep tabs on what's going on with them, or else you might miss something important. And with that said, a lot of the daily news that comes out is just noise. Most of it's definitely not life-threatening. Most of it's really not worth paying attention to. But you still want to be aware of what's going on with your holdings, and over time you'll be able to differentiate what's worthwhile and what you can actually just ignore. Long story short, if you're going to be investing in individual companies, even if they are these sleep well at night stocks, you need to keep tabs on them. You need to stay in the loop. And if that's not something that you want to do, then it's probably best to just stick to ETFs, and that's totally fine. But either way, that's an important thing that you'll want to learn about yourself as an investor. So I think there's a point in every investor's journey where things really start to click, and you get to a point where you start to feel like you've got it all figured out. You know, you've built a solid portfolio, you understand the basics of reading financials and looking at stocks, you've got some dividend growth going, and it can be tempting to just go on autopilot from there. But the moment you start thinking there's nothing left to learn is the moment you start getting comfortable and complacent, and things can start slipping through the cracks. The truth is, the market is always changing. Every day it is something different. The businesses you own are always evolving, and your own goals and appetite for risk over the years are going to change too. You're going to change. You know, what made sense for you 5 years ago might not make sense for you today. I think this is something that we've all experienced if we've been in the market long enough, but you only figure that stuff out by staying curious, you know, by reading, studying, reflecting, and just continuing to ask questions even when you think you have all the answers. At the end of the day, the best investors aren't the ones who think that they already know everything. They're the ones who are open to learning forever and understand that this really is a lifelong game of learning. And when you get to the root of it, I think that's what makes this thing so much fun. You know, like we talked about earlier, it's human nature to want things as fast as possible. We want what we want, and we want it right now. But when it comes to reaching financial freedom, and when it comes to anything that's actually worth having, there are no shortcuts to getting it. In other words, you can't skip to the end. One thing you'll learn, though, as you go through this is that even though living off dividends is going to be a whole lot of fun, and the time it takes to get there will be totally worth it, there's also a lot of fun in the getting there. You know, there is so much to learn along the way, and at least in my opinion, like I said earlier, that's one of the things that makes all of this worthwhile. You know, people ask me all the time, why would you buy individual stocks and have to spend all this time researching them and, you know, staying in the loop on them and know what's going on when you can just buy ETFs and call it a day and not have to think about it? And the truth is, I like thinking about it. Spending time learning about investing and researching stocks has taught me so much about a wide variety of subjects like accounting, finance, and human psychology, just to name a few things. Granted, it does take a lot of time, but for me, it's fun, and I think it's totally worth it. Doing this has brought about a lot of personal development, and I think I've learned so much more than if I would have just gone all in on ETFs. And also, I've made more passive income than I ever thought I would, which is what I'm telling you about in this next video right over here. In this one, I'm sharing exactly how much I've made with dividend investing over these last 5 years, and we'll also take a look into the future to see how much dividend income I might make over these next couple of decades. It's going to be pretty sweet. So click right over here to check that out, and I'll see you in the next one.